Right now, at this exact moment, the models that called silver's move from $18 to $30, the same models that flagged the gold breakout before it happened, are spitting out a number that most analysts refuse to say out loud. Not $150, not $200. The number is $350 on the conservative end, and $500 if the mechanism that's been quietly building since 2020 fully detonates. And here's the part that should stop you cold. Those numbers are not the bullish case. Those numbers are the math. Paper says one thing. The vault says something entirely different. And the gap between those two realities is wider right now than it has been at any point in recorded COMEX history. You're watching this because the mainstream won't show you this. CNBC won't run this segment. Bloomberg won't put this chart on the screen. Because the moment the general public understands what the ratio between paper claims and physical ounces actually looks like right now, the questions become very uncomfortable for some very large institutions. So let's go through it, all of it. The data, the precedents, the mechanism, and what it means for your stack, your savings, and your understanding of what silver actually is in this market. You need to stay with me until the end of this video because the number I just gave you, $350 to $500, is going to feel absurd for approximately the next 4 minutes. And then it's going to feel inevitable. That shift in your thinking is exactly what the institutions need you not to experience. So subscribe right now, hit the notification bell, and let's get into the data that they are hoping you never see organized in one place. Here is the core thesis. Silver is not underpriced because of ignorance. Silver is underpriced because of architecture. The entire paper derivatives market that sits on top of physical silver was designed, not accidentally but deliberately, to allow the price of silver to be expressed in terms of a contract that has almost no relationship to the physical metal underneath it. When you understand that architecture, when you see how many paper ounces have been created relative to the physical ounces that actually exist in deliverable vaults, the number $350 stops being a prediction. It becomes a pressure release calculation. The question is not if, the question is when and how violently. Let's start with the anomaly. One number, one data point that should not exist in a functioning market. As of the most recent COMEX positioning data, the open interest in silver futures, meaning the total number of contracts outstanding that represent claims on silver, translates to approximately 1. 2 billion ounces of silver. Read that again. 1. 2 billion ounces of paper silver exist as open claims in the COMEX system right now. The total amount of silver in COMEX registered vaults, meaning the silver that is actually available for delivery against those contracts, sits at approximately 108 million ounces. That means for every single ounce of real, physical, deliverable silver sitting in a COMEX vault, there are roughly 11 paper claims. 11? This number does not exist in a fair market. A market where 11 people hold a legal claim to the same single ounce of an asset is not a price discovery mechanism. It is a confidence game. And confidence games function perfectly until the moment they don't. But that's not the part that should concern you. Because 11 to 1 sounds alarming until you zoom out and look at the broader picture of total silver derivatives exposure globally. When you include OTC contracts, over-the-counter silver derivatives that are traded directly between institutions and are not reported through the exchange, independent analysts tracking the Bank for International Settlements data estimate the total paper silver exposure globally at somewhere between 200 and 400 times the annual global mining supply. Annual global mining supply of silver is approximately 820 million ounces per year. Even at the conservative 200x estimate, you are looking at a paper silver market that would take over 200 years of every mine on Earth running at full capacity to physically back. That is not leverage. That is a fiction. And the price you see on your screen when silver trades at $33 or $35 is the price of that fiction, not the price of the metal. Once you understand the ratio, the price action makes sense. Every single time silver has approached the moment where physical demand threatens to overwhelm the paper system, in 1980, in 2011, in the brief GameStop era squeeze attempt of 2021, the same set of tools gets deployed, margin requirements get raised overnight, new position limits get announced, the narrative shifts to speculative excess and overheating, and the price comes in, not because the fundamental case for silver weakened, but because the paper architecture requires the price to stay within a range that preserves the illusion that 108 million ounces can satisfy 2 billion ounces worth of claims. They need the music to keep playing. They need you to keep believing the paper is the same as the metal. Now let's build the pattern, because one data anomaly can be explained away. What you cannot explain away is the same anomaly appearing across 5 separate data streams simultaneously. That is not noise, that is signal. Data point 1, the Shanghai premium. Right now, silver trading on the Shanghai Futures Exchange is carrying a premium to COMEX silver of between $1.80 and $2, 40 per ounce. That premium is held through every paper-driven price smash over the last 8 months. The premium held through the entire dump. When COMEX silver got hit in February, when it got hit again in March, when the algorithms ran stops in both directions, the Shanghai premium didn't close. It widened. That is Eastern physical buyers telling you in real time that they do not accept the Western paper price as the real price. They are paying more consistently, persistently, month after month. That gap is the physical market speaking. And what it is saying is that the paper price is being manufactured. Data point 2, the lease rate inversion. Silver lease rates, the cost to borrow physical silver from a vault for a period of time, have gone deeply negative at certain points over the last 18 months. A negative lease rate means institutions are effectively being paid to borrow silver. In any other commodity market, that would indicate extreme oversupply. But silver inventories are not showing oversupply. They are showing structural tightness. So why would you pay someone to borrow a metal that's supposedly abundant? Because the institutions doing the borrowing need the physical ounces to settle delivery obligations they cannot otherwise meet. They need to rent your silver to paper over the gap between what the paper market says exists and what actually exists. Wall Street is not confused. They know exactly what this means. And the fact that this dynamic has persisted is proof that the gap between paper obligations and physical reality is not getting smaller. It is getting larger. Data point 3, the industrial demand floor. This is the part that even the silver skeptics cannot argue away. Silver is not just a monetary metal. It is the most electrically conductive element on Earth. And the electrification of the global economy, solar panels, electric vehicles, grid storage, 5G infrastructure, advanced military electronics, is creating an industrial demand floor that is entirely new. The Silver Institute's most recent data puts global industrial silver demand at 654 million ounces in 2024. The entire global mine supply was 820 million ounces. That means industrial demand alone consumed 79% of everything the mines produced, before a single coin was minted, before a single ETF share was created, before a single futures contract was settled with physical. Industrial demand is eating the supply chain from the bottom up, and the paper price hasn't even begun to reflect it. And then something strange happened to the vault numbers. In a 72-hour window in January 2025, COMEX registered silver inventories dropped by 11. 4 million ounces. That is not a normal settlement cycle move. That is a drawdown. Someone, or a group of someones, pulled 11. 4 million ounces of physical silver out of the registered category, meaning out of the pool available for futures contract delivery, and moved it to eligible status, which means it's held in the vault but no longer available to settle paper contracts. When you see a move like that, you are watching physical holders quietly withdrawing their metal from the paper system. They are making a decision. They are saying, I do not trust this paper contract to represent my silver. I want my ounces out of the system. And they are doing it quietly, in 72-hour windows, hoping the news cycle doesn't notice. 11.4 million ounces in 3 days. And nobody in the mainstream financial press ran a single segment on it. Data point 4. The JPMorgan position. JPMorgan Chase holds what is widely believed to be the largest single stockpile of physical silver in private hands in the world. Estimates from researchers analysing COMEX vault records, regulatory filings, and warehouse receipts put JPMorgan's accumulated physical silver position at somewhere between 800 million and 1 billion ounces accumulated since 2011, the year silver hit $49. 82 before being crushed by 5 consecutive margin hikes in 8 days. Why does this matter? Because JPMorgan was simultaneously the dominant short-side player in silver futures for years, meaning they held massive bets that silver would go down, while accumulating physical silver at every price smash their short positions helped create. Paper says they were bearish on silver. The vault says something different. They were buying every ounce they could touch, while their paper positions pushed the price down to give them better entry levels. If that isn't the definition of a two-track operation, nothing is. Data point 5. The mining cost floor. The all-in sustaining cost for primary silver miners, meaning the true cost per ounce to get silver out of the ground, process it, sustain the operation, and deliver it to market, averaged 16s, 23 per ounce in 2020. That number has risen to approximately $21 to $23 per ounce for most mid-tier producers as of late 2024, with some operations running above $26 per ounce when energy, labor, and regulatory costs are fully loaded. At a spot price of $33 to $35 per ounce, the margin for silver miners looks acceptable on paper. But here is what should really disturb you. The marginal cost of new silver production, meaning the cost to open a new mine, develop a new deposit, build the infrastructure, is estimated by industry analysts at $35 to $45 per ounce before the first ounce ever ships. At current prices, the economic incentive to develop new silver supply does not exist. And in a world where industrial demand is growing 8% per year and mine supply is essentially flat, you are engineering a supply crisis in slow motion. The price will have to go to where it economically justifies new production. And that level is not $35. It is not $50. It is somewhere in the range that makes $350 start to look conservative. Now let's connect all 5 data points to what happened the last 2 times this exact configuration appeared. Same playbook, different decade. In 1979, the Hunt brothers began accumulating physical silver. The paper to physical ratio at COMEX at the time was lower than today, roughly 3 to 1, but the dynamic was the same. Physical accumulation was running ahead of what the paper system could comfortably manage. By January 1980, silver reached 40 nales, 45 per ounce. The COMEX responded by implementing Silver Rule 7, which restricted silver futures trading to liquidation orders only, meaning you could only sell, not buy. They changed the rules of the game mid-game, and the price collapsed from $49 to $11 in 8 weeks. Not because the fundamentals changed, because the rules changed. But here's what the mainstream history books don't emphasize. The physical silver that the Hunt brothers held didn't evaporate. The price did, the metal didn't, and at $49 in 1980, adjusting for inflation to $20-25, silver peaked at approximately $185 per ounce in real terms. We have not even reached the inflation-adjusted 1980 high. Not even close. In April 2011, silver reached $49. ITU, the paper-to-physical ratio at that time was approximately 45 to 1. 5 consecutive margin hikes in 8 days drove the price from $49 to $32 in under 2 weeks. The same playbook, and the same outcome for anyone who was leveraged on the paper side, but once again, physical silver didn't disappear. It just got cheaper, for a while, and everyone who held physical through that smash and continued to hold it into 2020 watched silver go from $12 in the COVID crash to $29, $40 in August 2020 in 4 months. Once his accident, twice his coincidence, 3 times his policy. Right now, in 2026, the paper-to-physical ratio as measured by COMEX, open interest to registered inventory, is 11 to 1 and rising. The industrial demand floor is entirely new. It did not exist in 1980 or 2011 at anything near current scale. The Shanghai premium is structural, not episodic. The lease rate dynamics are screaming physical tightness. And the BRICS nations, Brazil, Russia, India, China, South Africa, and their new member states, are actively building settlement systems that bypass the dollar-denominated COMEX pricing mechanism entirely. The West is still pricing this like 2019. The East stopped pricing it like 2019 approximately 24 months ago. That divergence cannot persist indefinitely. When it resolves, it will resolve in the direction of physical reality, not paper fiction. There are 3 types of people watching this video right now, and I need you to understand which one you are. Type 1 is watching their silver ETF on their phone and thinking, if silver is going to $350, why isn't it moving right now? If this is so obvious, why hasn't the market priced it in? And they're getting nervous, second-guessing their thesis, wondering if they're wrong. Type 1 is asking the right questions, but hasn't yet understood that the answer to those questions is the manipulation thesis itself. The market hasn't priced it in because the paper market is specifically designed to not price it in. The delay is not evidence that the thesis is wrong. The delay is evidence that the mechanism is working exactly as designed. Type 2 has been in silver for 5, 6, 7 years. They bought at $29 in 2020. They watched it run to $29 again in 2024 after a 4-year round trip. They are exhausted. They are questioning everything. They are this close to selling their stack because they cannot see the catalyst, and they've been waiting long enough. Type 2 is the person the institutions most need to break. Because every ounce they sell is an ounce that moves from patient hands to institutional hands at a price the institutions set. Type 2 needs to understand that the thesis is not just intact. The evidence for the thesis has gotten stronger every single year since 2020. The ratio went up. The industrial demand went up. The Eastern premium went up. The lease rate dynamics got more extreme. Everything that matters got more extreme. The price hasn't moved to reflect that yet. But that's not a thesis failure. That's a coiled spring. Type 3 understands exactly what is happening. Type 3 looks at the 11 to 1 ratio and understands it's a pressure measurement. They look at the Shanghai premium and see Eastern buyers pricing physical reality. They look at the JPMorgan vault accumulation and understand that the biggest short in the paper market spent over a decade buying every physical ounce it could touch. And Type 3 understands something specific. You cannot be long paper silver through the resolution of this tension and expect to receive physical metal. When the paper-to-physical ratio breaks, and it will break because the 11 to 1 system cannot survive 2 billion ounces of claims against 108 million ounces of deliverable metal indefinitely, the paper price and the physical price will diverge. The paper will settle in cash. The physical will settle at a price that nobody currently believes. Type 3 holds physical, only physical, and Type 3 is not in a hurry because they understand that the longer the institutions can hold this together, the more violently it unwinds when they can't. Here is where the $350 to $500 number comes from, and why I said at the start of this video that it's not bullish enough. It's a calculation, not a prediction. When you model the price of silver that would be required to bring the paper to physical ratio back to a level consistent with a functioning market, say 3 to 1, the level it was at in 1979 before the Hunt brothers squeeze, you need either the paper open interest to collapse dramatically or the physical available for delivery to expand dramatically. Neither of those things can happen quietly. A collapse in paper open interest means a liquidation cascade that drives the paper price down, while the physical price skyrockets due to immediate demand to convert from paper to physical. An expansion in physical deliverable inventory requires miners to flood the market at prices that don't yet exist to incentivize the production. In either scenario, the price that equilibrium is found at is dramatically higher than today. The $350 figure comes from applying the 1980 inflation-adjusted peak and the current industrial demand multiplier to the ratio. The $500 figure comes from modeling what happens if even 2% of the global bond market, currently sitting at $130 trillion, seeks silver as an alternative store of value during a dollar crisis. 2% of $130 trillion is $2. $6 trillion. The entire above-ground investable silver market, valued at current prices, is approximately $1. $3 trillion. A 2% reallocation from bonds to silver would require the price to more than double just to absorb the flow. These are not wild speculations. These are pressure calculations. The only variable is timing. This is not financial advice. Your money, your decisions. But let me give you the clearest framework I can for thinking about what comes next and what the informed stacker should understand. If you hold physical silver, coins, rounds, bars, you are in the most defensible position available in this market. Not because silver is risk-free. No asset is. But because physical silver is the one form of silver that cannot be settled in cash against your will. When the paper to physical ratio breaks, the paper holders get cash at whatever settlement price the exchange sets. The physical holders get to name their price or not sell at all. That asymmetry is the entire trade. If you hold silver through an ETF, SLV being the largest, you need to read the prospectus carefully and understand what it actually says about your ability to redeem for physical metal. Most silver ETFs are structured so that only authorized participants can redeem for physical, and the minimum redemption size is typically 50,000 to 100,000 ounce baskets. As a retail investor, you cannot redeem for physical. You can only sell your shares for cash. In a scenario where the paper price and the physical price diverge significantly, you will receive the paper price, not the physical price. That is a risk that most ETF investors do not fully understand. If you are thinking about entering a position in silver right now and the price action of the last 18 months has you uncertain about timing, understand this. The average price of silver over the last decade is approximately $21 per ounce. The average all-in sustaining cost of production is now $22 to $23 per ounce. You are buying silver at a price that is approximately equal to the cost to produce it. You are not paying a premium. You are buying metal at near its production floor, with industrial demand growing at 8% annually, with a paper-to-physical ratio that is at all-time historical extremes, and with Eastern buyers paying a persistent premium to the paper price. If this is not a favorable setup, then I don't know what one looks like. And if you bought silver at or near the 2020 peak of $29 and watched it come all the way back and are now sitting even or slightly underwater, understand that you are not a victim of bad analysis. You are a victim of timing in a manipulated market. The fundamentals that made you buy have not degraded. They have strengthened. The question you should be asking is not whether to sell. It is whether you can afford to accumulate more at the current price before the mechanism breaks. If you're not subscribed yet, fix that right now. What I'm putting together in this channel is a systematic breakdown of the exact mechanisms, the ratio data, the vault flows, the lease rate signals, the Shanghai premium tracking that the institutions use to manage the silver price, and that you can use to understand when the system is under maximum stress. Subscribe, hit the bell, and let's keep going. Now let's talk about what happens next. Not as a prediction, but as a consequence chain that follows logically from everything we've laid out. The mechanism that keeps the paper price anchored has three load-bearing pillars. Pillar 1, enough physical exists in COMEX registered vaults to make delivery threats feel manageable. Pillar 2, Eastern buyers continue to pay the Shanghai premium but don't escalate to large-scale COMEX delivery demands. Pillar 3, retail stackers and small institutions can be convinced to sell into paper-driven smashes, refilling the physical supply chain from the bottom. All three of these pillars are under simultaneous stress right now, and that is new. In 2011, Pillar 2 was not under stress. The Shanghai market was much smaller and less liquid. In 2020, Pillar 1 was not under maximum stress. COMEX registered inventories were higher. In 2016, Pillar 3 was working perfectly. Retail capitulation was keeping the physical supply chain fed. Right now in 2026, COMEX registered inventories are near post-2019 lows, the Shanghai premium is structural and widening, and retail stacking demand has reached a level where the physical supply chain is actually running backlogs at major mints and distributors. All three pillars are stressed at the same time. Here's what they filed at 3 a.m. that nobody is talking about. The CFTC, the Commodity Futures Trading Commission, the regulator responsible for overseeing the futures markets, released position limit data in the last quarterly cycle showing that the concentrated short position in silver futures, meaning the largest 4 or fewer traders holding short positions, is sitting at a level that represents approximately 143 days of global mine production. 143 days. The four largest short holders in the silver futures market have sold forward more than 4 months of global mine output in a commodity with no above-ground surplus, with growing industrial demand, with tightening registered vault inventory, and with Eastern buyers pulling physical faster than Western paper is replacing it. 143 days. That number should keep you awake. Because when those positions need to be closed, either because the price moves against them, or because delivery demands can't be met, or because the regulatory environment shifts, the buying required to close 143 days of global mine output in short positions will not happen quietly. Let me give you a specific comparison to anchor this. The silver short position as a percentage of annual mine supply is currently higher than the concentrated position that existed just before silver's 32% single-month move in September 2010, which was the beginning of the run that took silver from $19 to $49. The setup is not just similar. On every quantitative metric that mattered before that move, the current setup is more extreme. The ratio is higher. The physical tightness is more severe. The industrial demand floor is larger. And the geopolitical pressure on dollar-denominated commodity pricing is an entirely new variable that did not exist in 2010 at anywhere near this scale. Once you understand the ratio, the price action makes sense. Every time silver gets close to a level where delivery stress becomes visible, where the math of 2 billion paper ounces against 108 million physical ounces starts to become impossible to ignore, the paper gets sold aggressively into thinly traded hours. 2 a.m. Eastern, Sunday night futures open. The hour before COMEX close, and the price drops, the open interest resets slightly, and the pressure valve releases just enough to keep the game going another few weeks. But the underlying tension doesn't dissipate. It builds. Each cycle of smash and reset leaves the physical market a little tighter. The lease rates a little more distorted, the Shanghai premium a little more persistent, and the registered inventory a little lower. The can is getting kicked down a road that is running out, and the end of that road has a very specific shape. The end of that road looks like this. At some point, triggered by some combination of delivery failure threat, geopolitical shock, dollar devaluation event, or simple exhaustion of the short covering capacity, the paper price and the physical price separate. Not by $2, not by $5, by a number that will shock everyone who wasn't paying attention. When the world realizes you cannot buy physical silver at the paper price becomes irrelevant. The physical price becomes the only price that matters. And the physical price, in that moment, is set by the last willing seller and the first desperate buyer. In every historical precedent for this type of paper-to-physical divergence, gold in the 1970s before the 1971 dollar break, oil futures during the April 2020 negative price event, palladium in 2019 when Russian supply constraints emerged, the physical price moved to a level that was unthinkable the week before it happened. Silver's version of unthinkable is somewhere between $350 and $500. And I'm telling you right now, those numbers are not the ceiling. Those numbers are the pressure release point. Wall Street is not confused. They know exactly what this means. The same institutions that have run the short side of this market for decades are not confused about the ratio. They are not confused about the lease rates. They are not confused about the Shanghai premium or the registered inventory drawdowns. They built the architecture. They know every number, and they are managing the exit from that architecture in a way that lets them be on the right side of the physical accumulation before the paper price catches up to physical reality. The question for you is not whether this happens. The question for you is which side of this transition you are on when it does. There will be a moment, and I cannot tell you exactly when, but the data tells me it is closer now than it has ever been in the modern era, where you will wish you had paid more attention to these numbers, where you will look at the COMEX data and the Shanghai premium and the lease rate charts and the concentrated short position and understand that the information was available, that it was public, that it was being discussed, and that the price that silver trades at in that moment will make the $33 or $35 you see on your screen today look like the most obvious buying opportunity of the last 20 years. Same playbook, different decade, and this time the industrial demand floor means there is no version of this story where the supply catches up with the demand before the price has to do the work that only price can do. Here is what you do with this information. You understand that you are not a speculator betting on a breakout. You are a holder of a physical asset in a world where the paper representation of that asset is mathematically disconnected from reality. You do not panic when the paper price drops in a 2 a.m. algo session. You understand that every manufactured smash is a transfer from weak hands to strong hands, and you decide which set of hands you have. You watch the ratio, you watch the registered inventory, you watch the Shanghai premium, you watch the lease rates, and when those four indicators reach a configuration that has never existed before without a massive price adjustment following, you will know what it means. Because you watched this video, because you understand the architecture, and because you were paying attention when the mainstream was talking about something else entirely. Drop a comment below. Tell me, what is your silver price target for the next 18 months, and are you holding physical, paper, or mining shares? I read every single comment, and the conversation in the comments on these videos is some of the most informed analysis you will find anywhere. Send this video to one person in your life who still thinks silver is just jewelry and electrical wire. One person who deserves to understand what the ratio means before the ratio resolves itself. Most people will never see this information. The mainstream media will not cover it. But you saw it. Now help someone else see it. Screenshot this. Hold me accountable. Save this video. Come back in 12 months.